Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis, deep dive into the financials and tell you about the key risks and triggers going forward. Let's not waste any time and get to our first stock for the day. My colleague Nigel gets us with this very special deep dive on APAR Industries.
APAR Industries has grown into a diversified billion-dollar company with global presence and is a trusted manufacturer and supplier of conductors, a wide range of cables, specialty oils, polymers and lubricants. The company can be termed as an ancillary play on the power capex, not just in India, but they've also got global presence. Let's focus on the various verticals of the company, starting with the conductors business. That's the oldest and that's the largest part of their business. They have a technology tie-up with CTC Global and exports account for a large part of their business. Well, their second segment is clubbed between specialty oils and lubricants, and they're the third largest in transformer oils business globally. They globally supply the entire range of tea oils to new corrosive sulfur standards and were the first in India to have tea oils approved for ultra-high voltage transformers. The third part of their business is the cables business, but that's largely industrial cables, though they have been gradually growing the B2C part of their business. For this, they have roped in Mr. Sonal Bhutra to endorse their LDC range. APAR is also the largest and most innovative supplier to nuclear power, defense and railway sector as well. The conductor business, well, it continues to command the maximum amount of revenue as well as EBITDA contribution. While the transformer and specialty oils business, that's second in terms of revenue contribution, but the cables business was a large contributor to the EBITDA in the past year, as margins were better in the cables business in comparison to the tea oils business. Over the past few years, bulk of the growth has come from exports and the company's continued focus on value addition. In their cables business itself, premium products, they contribute close to around 44% in the past fiscal. Exports have increased from around a third of their business to around half of their total business. The EBITDA in FY23, well, it surged due to higher margins in conventional, premium conductors, increase in cable volume, and also potential benefit of supply-demand imbalance, which led to a surge in exports. On a per-unit basis, the conductor business EBITDA per unit, that surged to around 44,000 rupees. That was aided by favorable market conditions post-COVID, as customers, they paid a premium for reliable delivery. In the specialty oils and lubricants business, the EBITDA per KL came in at around 4,780 per KL. That was a little bit lower on a year-on-year basis. Well, the management has listed out the order book positions in both the conductor as well as cables business. They've also listed the key growth drivers for the company going ahead. Well, in FY23, the total interest outgo was around 300 crores, which effectively means the total debt is around 3,500 crores. This as per analyst estimates. Well, the stock trades at around 16 times trailing earnings, but the street believes in the next couple of years, well, we'll see consolidation of earnings because FY23 was a blockbuster year and may not get replicated. The key downside risks include continued slowdown in the power sector capex, if at all, and rupee volatility as well. Well, before we wind down, let's run you through the shareholding pattern that should come up for you on the screen. But to understand the company in greater detail, well, let's go across to Mr. Kushal Desai, the Chairman and Managing Director of APAR Industries. Mr. Desai, thank you so much.
Welcome to our office.
Mr. Desai, you had a very, very good year. FY23 was brilliant. The problem about having a good year is, for the next year, recency bias will say, hey, you had such a good year, how is this one shaping up? So we're 2 months into the year, that's FY24.
Right.
How are things panning out, both domestically as well as internationally? Are you seeing a fair bit of traction?
So we are seeing traction. Obviously, the financial results have a profitability component, which was very, very high last year. There were a lot of tailwinds. Going forward, the key thing is the addressable markets which we are looking at. And what is driving growth for us, not only for this year, but for the next several years, is the addition of renewable energy.
Right.
And so as you have solar installations, wind installations that are taking place all over the world, and this is driven by commitments given on COP26, COP27 by governments.
Right.
And in developing countries like India as well as China, whether you call it, it's like almost semi-developed in that sense. And then you have the United States, you have Europe, you have Australia.
Yes.
There's massive amounts of new power sources going in. So you have a cable intensity which takes place within the generation area,
Right.
in the substation, and then transmission lines come in as you evacuate power to get it to consumers. So we are seeing across, and then for every substation you have transformers.
Okay, all right. You mentioned China briefly out there. One of the beneficiaries of China being absolutely, lockdown or lack of supplies coming out of China would be APAR Industries, right? Because lower supply from there and people want better quality as well. Maybe that could be a potential winner for you.
So
Tell us more about that, because China is reopening now.
Yes. So Nigel, what's happened is that there is clearly a China plus one advantage that a country like India has, as people are looking for alternate sources of supply, reliable supply. And because APAR has been exporting products, people are familiar with utilities, EPC contractors over the last several decades. There are certain geographies where, like the United States, Australia, where there is a very concerted effort to add suppliers who are not of Chinese origin.
Okay.
And there are some tariffs, like in the United States, that are also helping in this regard.
Right.
So there are some markets where we have a vantage position. There are other markets where actually the Chinese have a better situation because they have MFAs and agreements in place,
Right.
where the duty structure is a little bit lower than ours. So now, with things having pretty much come to normality, even in China, the competitive intensity in some of these markets where there's a level playing field for China and India, it has increased.
Well, Mr. Desai, let's focus on your business vertical-wise. And the
Right.
largest part is the conductors business,
That's
right?
correct.
So if you could tell us, your focus has been on value addition. Over the last few years, the value addition component has gone up drastically.
Yes.
And the tailwind for you has been the not so high value products have been finding demand in the export market. So how is the conductor business shaping up? If you could give us a sense out there. And also in terms of a volume growth, what are you targeting this year?
Let me show you a product, Nigel. So, these are what are called HTLS or high efficiency conductors. And the differentiation is that if you see the core here, it's a carbon composite core.
Okay.
The same sort of materials that are used in an aircraft for the outer shell of the aircraft. And they don't have a coefficient of linear expansion. So when you carry a lot of more current, the conductor gets a lot hotter. It can transmit significantly more power. So when you have urban concentrated centers like Mumbai, where power is growing every year,
Yes.
right of way not available.
Right.
These sort of conductors is what we have come up with. And we design a complete turnkey solution. So we sit with the utility, figure out what is the right conductor, utilize the existing frames which are there,
Right.
and the same right of way for delivering up to 200% more power on the same line. And then if you see here, these are copper conductors which are used.
And they are used
They're
in?
used in the railways.
Okay.
So if you see, India has had this massive electrification going on of the railways. It was
Yes.
quite ironical that we were importing fuel and oil to move coal, because coal is also moved by trains.
Right.
So when the government moved towards a program of electrification, we became the largest supplier of these sort of copper cables or copper conductors for the electrification of the lines.
Okay, so I just wanted to understand in terms of the conductors business, what kind of a volume growth are you looking at? Last year you did around 160,000, I think, roughly.
About a 10%, 10 to 15% growth. 160,000 is what we did. We've given a guidance of getting to about 180,000 tons this year.
And what kind of capacity do you have? Do you think, since the market is growing at such a brisk pace, will you have to add capacity?
So we are going through a big expansion in CapEx, about 400 crores, which will go in over about 18 months.
Okay.
Of which 100 crores is dedicated to conductors and rod capacities. Because, as you see, some of these higher value conductors are all made out of aluminum alloys.
Got it.
And we have our own alloying technology.
Right.
And so, this expansion allows us to increase capacity. It also increases fungibility. So depending upon the kind of demand that people have, or utilities and EPC contractors have, we can switch the product lines to meet their requirements.
And post this capex, what does your capacity go to in the conductor segment?
It will go closer to about 200,000, but besides that, we will be able to produce a lot of high value conductors pretty much through all the plants.
Okay, so in terms of value addition, I think you're around 45-50% approximately. So where do you see this number stabilizing, value addition as a percentage of conductor sales, and also EBITDA per unit? last year was a dream year, 44,000 odd.
Last year we had a whole lot of tailwinds.
Yeah.
The 2 years prior to that did have headwinds because of all the COVID-related issues. But we've guided that about 25,000 a ton, is what is a sustainable level. If there are any specific tailwinds, it could be a bit higher.
Okay, you also spoke about the cables business. Cables, you're more into industrial cables. That's not so much into B2B, but you're also looking at growing that part of your business.
Actually we have, this wire that I'm holding is a wire which is called APAR Anushakti wire.
Yes.
And if you see there, we've got Sonal Bhutra, as the brand ambassador for those wires. The uniqueness of these wires is that they can carry up to 50% more current.
Okay. So as of now, I understand that the cables business, the B2C part of it, that has grown from around 120, 130 crores to I think 175 crores approximately.
Yes,
cables and wires business. So what is the outlook out there?
From 100 we went to 175.
Right.
This year we are targeting 275 to 300.
So just mathematically going by rate, maybe 2027, 2028, you should be at 1,000 crores?
That's the aspiration. We are working towards that.
Okay, all right. So you have told us a little bit about the wires and the cables part of the business. We spoke about the conductors as well, but there's another element in there.
Yeah, the lubricant side.
Lubricant side, yeah.
So for example, let's see, we have these two products. This is Cruise and this is Icent. So we do the E&I brand for South Asia. So we have the license. We manufacture and distribute E&I branded products in India, Bangladesh, Sri Lanka, Nepal. This area. So Icent, for example, is a synthetic. It's a 100% synthetic product.
Okay.
Top of the line. For high-end passenger cars.
Right.
Very low emission, meeting all this new Bharat 6, Euro 6 standards, etc.
Okay, so now in terms of this part of the business, however you want to term it, I think as of last year you did around 480,000 on the volume aspect.
Yes, 480,000 kiloliters.
So where do you see that number headed? What kind of a volume growth are you looking at? And also I think in terms of an EBITDA per KL, you are in that vicinity of around 4,500.
So I think we are guiding about 5 to 5,500 because that's what we think is a level which is a sustainable level that we can get to. We see a growth of about 5 to 7%.
Well, Mr. Desai, the power story here in India is looking up. And that will be good in terms of business for cables as well as conductors. But I understand that the US market as well is a big market. Tell us more about that. What is the size of the US market? How much do they import? And also, what is India's contribution out there?
So, it's all being driven by renewable energy, as I mentioned earlier. So today the US is adding about 13 gigawatts of renewable energy a year. They're going to take it to 30 gigawatts in the next couple of years. From what I understand is that about $20 billion worth of cables were imported in the year 2021.
Okay.
And of that, India has exported not even 500 million. Given the fact that we have the relationships that India has with the US, our tariffs haven't changed relative to China, which is much higher. There's a big scope of actually moving product and selling into the US.
Explain this to us. The interest cost that you're paying is around 300 crores.
Yes.
But you're not sitting on a big debt. I think acceptances are
so what happens is, Nigel, just let me spend a minute to explain that, so we end up importing aluminum, base oils and many of our raw materials on extended credit terms, suppliers credit. Simply because the delivery cycle is a bit long. So you manufacture and in many cases, customers want it on a DDP basis. So you have to deliver it to a site, in the US or a warehouse in the US, and then they pay you 30 days after the product has reached.
Okay.
So it enables us to run the cash flow well. The cost of interest is borne into the costing.
Okay.
Many of our customers are EPC contractors, and they also have a long cycle in terms of finally installing, getting paid on a milestone basis.
Right.
So often they end up opening 120-day, 180-day letters of credit on us.
Okay.
Usually you have 45 to 60 days which is interest free. That are normal credit terms.
And post
the rest of it is interest bearing.
Okay.
So if you see about 4,000 crores of LCs which we have outstanding, against that you have about 2,000 crores worth of LCs that you have from your clients.
Okay.
So what gets captured in this 300 crores is the LC opening charges, interest, various other bank charges.
Right.
and all of that.
Okay, explains
So
that.
if you can't directly correlate it to the amount of debt that the company has.
You're right. All right. Then final question, Mr. Desai. You have 3 businesses. You're sounding pretty optimistic on all 3. At some point of time, would you like to, demerge it, keep them separate, or do you think they're all interlinked? Because that could unlock some value.
Let me explain to you something in a very simple manner.
Yeah.
We see all of them being very synergistic. So we talked about renewable energy. You take a solar installation. So you have solar panels. You have wires or string cables that go around the panels, a cable that brings it to an inverter,
Yeah.
then a cable that takes it from the inverter to the substation.
Yes.
The substation has transformer oil in it because the power is then stepped up for transmission.
Yes.
Then you have a transmission line which has a conductor. It goes finally to a residential area, commercial area,
And again-
etc. Again, you have a substation
Yeah.
with transformer oil in it, and then you have wires and cables that bring it right up to the last mile.
So you believe it's best the businesses are kept together?
Absolutely, and I think today with this, especially with this whole renewable energy, with the whole change in mobility.
Yes.
We spoke earlier about, here's an award actually which APAR got from Siemens, a global mobility award.
Yeah.
Because we did the cabling for the Ahmedabad Metro, for which they actually gave us. Siemens was the EPC contractor for it. So again, you've got electricity running there. We do transformer oil which goes into the traction transformers that run the locomotive.
Yes.
A lot of synergies in the business.
So best kept together.
Yes, absolutely.
It's been an absolute pleasure talking to you.
Thank you,
Mr.
Nigel.
Desai. Thanks so
Thank
much.
you for having me.
Thank you.
All right, that was a deep dive into APAR Industries, but time to slip into a short break. We'll come back with another interesting stock. DreamFolks is in the Swotlight on the other side of this very short break. Welcome back. You're still tuned in Inside Out on CNBC-TV18. This is our Swotlight segment. And with air travel coming back with a bang in India, I thought of looking at some of the segments or sectors which are ancillary to this sector. And with increasing usage of airport lounges, DreamFolks came on my radar. Listed in September 2022 with a 55% premium to its issue price of $326, the company is an airport service aggregator and provides airport-related services such as lounges, F&B, spas, meet and assist and nap rooms and hotels for transit. In FY22, company had 95 to 97% share in the India-issued card-based access to domestic lounges and 68% market share of all the lounges in the country. Let's explain this via the domestic lounge market. Now, travelers can access lounges via loyalty program cards, which is around 5%. There would be digital or QR codes. 6% of them do walk-ins. Airline voucher is around 3%, and rest do it via credit or debit cards, which is a whopping 82% of the total access market. Of this 82%, DreamFolks has a market share of 95 to 97%. Now, let's understand the value chain of the lounge market. DreamFolks would have 3 types of clients. One would be the credit card company itself, something like Rupee or Diners Club. Second would be the banks who are the card issuers, something like Axis Bank, Bank of Baroda, HDFC Bank, ICICI Bank. Then you would have the corporate clients. There would be Indigo, Ease My Trip, Club Mahindra, to name a few. Now, these corporates, they tie up with DreamFolks, where DreamFolks issues cards or vouchers, gives app access to customers on clients' behalf, and this is via a hybrid model. And access is given to multiple services like lounge access, meet and assist, and the others which are mentioned here. Now, they have an asset-light model with minimal incremental capex needed to be deployed by the company regularly. This allows for high operating leverage. The major costs would be employee costs, of course, but that is around 4.9% of revenues on an average basis last few years. And technology costs are important as well, but they have been around 0.4% of the total revenues. Now, a quick look at the financials. FY20 and FY21 revenues, they were hit by COVID. FY22 did see some recovery, and then there was a big jump in FY23 to 773 crore rupees. Margins too haven't gotten back to those levels of 18%, but they have been between 16 to 17% in last 2 to 3 years, and they reported a loss in FY21, but this is after profits of 32 crores in FY20. From there, their profits have increased substantially, currently tracking 72 crores. But important to note, the revenue number, this is the deemed revenue, that is the value of service they provide to the client, but the actual revenues, they are only the commissions they earn from clients. Hence, the important metric to look at is the gross profit earned per customer. That was at around 137 rupees in FY20, then it saw a fall to 129 rupees in FY21 and FY22, and in FY23 there was a big jump to 156 rupees. Whether they can continue this or not is the key to track. Now, with every business there are some risks as well. The revenues and profits for DreamFolks are dependent on air travel growth. If passengers reduce, this would hit their revenues. Also, with rising fares, this number is key to track. There have also been talks of reductions in MDR rates, which is a rate charged by card issuing companies every transaction with a debit or credit card. If this is implemented, it could hamper DreamFolks' profitability as their clients might reduce spends on cashbacks and promotional benefits on cards. So that is a possible risk. In terms of shareholding, promoters hold 67% stake, mutual funds at 7%, and some notable AIFs and FPIs also hold stake in the stock. Okay, that was our Swotlight segment, but now we have run out of time on this episode of Inside Out. It's a goodbye from Nigel and I. But do write to us and tell us the companies you want us to discuss and you want to hear about, and we'll feature these on our show. Thanks a lot for watching.